The core philosophy in the book is use data to drive your decisions. And I think if you asked most founders, are you data driven? They'd all say yes. But we found in working with thousands of early stage SaaS companies, sometimes perception and reality are two very different things.
In your business, there is one metric you can use. The mistake I think a lot of folks make is collecting almost too much data. And so I think people say, oh, I'm data driven because I'm collecting a ton of stuff, but they're actually not sure what to do with the data. Maybe I'm making decisions off the data, but I'm still not prioritizing the stuff that actually matters. And that's where people drop the ball.
Well, Ben, in preparation for our conversation, I went to go to my bookshelf and pulled something out that I acquired many years ago. And something I didn't notice was I looked at the back and I realized that we've got a common friend. The second, I don't know what you call it, like quote or promo on the back of the book is Dan Martell. So I'm curious, how'd you meet Dan?
Oh, geez. Well, Dan's Canadian and I'm Canadian. And so, as you know, all Canadians know each other. So that I think that's how it happened. Honestly, I don't remember when I first met Dan, but it's from the tech. It is from the tech ecosystem, and so I've known him a long time. He was probably doing Clarity at the time, like a startup that he was running back in the day. I think that's what he was doing at the time out east. So yeah, tech ecosystem. It is a pretty small community in Canada.
Yeah, you just gave us all the ammo we need to continue to give Dan some shit for being Canadian for the next couple of years, because it does seem like you had me at, oh, you guys are both Canadian. Yeah, well, it makes sense that you're all best friends. Of course.
Yeah.
Yeah. It's mystery solved. Well, cool. I'd love to, there's a handful of things I want to unpack in our conversation today. You've had you have been at the epicenter of of the evolution of tech over the last 15, 20 years. And Matt and I both got our start in tech. I would call it maybe, I don't know which wave it was. We started in about 2013, 2015, exited our companies in 2019. But I've read books about and heard the stories of early days Silicon Valley, and that was where you got your start. So I love this, pick up the story and through lean analytics. And I think a lot of founders, the core philosophy in the book is use data to drive your decisions especially in the early stage of a startup, when you're still trying to figure out what is the product, who are we serving, what's the model. And I think if you asked most founders, are you data driven? They'd all say yes. But we found in working with thousands of early stage SaaS companies, sometimes perception and reality are two very different things. You peel back the layer and you realize that they're not. So can you walk us through a story or two of what it looks like to have lived out the lean analytics methodology? What does it look like? Describe how a founder actually interacts with data in a way that helps them. So maybe we help close some of the gaps for the gap for some of the founders that think they're being data driven right now and maybe aren't.
Yeah. It's a great question, because I think the mistake I think a lot of folks make is collecting almost too much data. So like, especially now, the book is 2013, now it's 10 years later. It's even easier to collect more stuff, and it's easier to read more stuff about data, right? Because there's just more content out there, benchmarks and this, and this is what you should focus on. So I think it's got even more overwhelming than it was. And so I think people say, oh, I'm data driven because I'm collecting a ton of stuff, but they're actually not sure what to do with the data or how to make decisions off the data. And that's really the principle of the book, which was collect everything. That's fine. Like, you never know when a piece of data or whatever might be useful, but try to be laser focused on what actually matters now. And using first principles, solve the most important problem now, not something that just doesn't matter. So I think it's the problems today are even worse than they were when we wrote the book, is one way of thinking about it. And again, like and I say we because Alistair Kroll and I, like co-authors of the book, when we wrote the book, we were also doing a very early stage accelerator called Year One Labs. And it was right around Lean Startup. We're like, we're going to apply Lean Startup methodology. And we built and funded 5 companies. They all happened to be consumer companies. But that wasn't the intent. It's just sort of how it materialized. But we took them through this model of, okay, first go validate what the problem is, then go build an MVP, then measure if people are using the MVP. Is it sticky? And we were writing the book, if you will, as we were applying Lean Startup and trying to make it more practical. And so, again, to me, I think what happens now is collect data. Maybe I'm making decisions off the data, but I'm still not prioritizing the stuff that actually matters. And that's where people drop the ball.
I'm not, that makes a ton of sense. I think Matt over here within arm's reach has got a hat that says, I love data. And if he had it his way, he'd have 1,000 rows of metrics and data, even at the earliest stage of a startup. So I kind of want to, I love to pick up these 2 ideas. Ben, where is too much data harmful? Like, do you have a scenario where you started working with a founder early on and they were tracking too much and you had to go through, because you work hands-on. I love what you do at Highline Beta. You think of yourselves as co-founders to the companies you're working with rather than investors, although you do both. Have you had to go through a series of paring back data for a founder to get focused on the most important thing?
Yeah, I think yes. We've had cases where folks are, again, collecting a lot, but not sure how to validate where the problem is. So to me, this is usually like, use an example of like a simple funnel, right? So we say, okay, I have an onboarding funnel to get to activation, and people are coming through the top, and I'm measuring traffic and I'm measuring conversion through the onboarding steps. And I can see, people are dropping off at step 4 in the process. And because the data tells me, like, I start with 100 people and it drops all the way down. And so a couple of things happen. One is my funnel good enough? So like out of 100, X come out the other end. Is that good? Is that bad? I don't know. And that's hard to know because there's a lot of variables, but also like, step 4, there's a lot of drop off in step 4. So then they go in laser focused on trying to fix step 4 in that onboarding flow, except they don't actually know what's broken with it. And so then they go into A/B testing it, take the button, move it from the left to the right, do whatever it is. And now I've got all these iterations of this thing. And at an early stage, probably not even enough people coming through the top of the funnel to get any material measurement of it. So like every change, I think, almost always improves things a little bit, but not enough to know if I fixed it. And so that's a good example, we see when a company first launches a product, or even before they launch, pre-launch, right? I'm like just getting people to the site and seeing if they'll sign up. But something's broken in that process, and now I'm just futzing around with it, and then I'm just obsessing over that thing as opposed to maybe focusing on something else that might matter, which is, look, I think you got enough people through. Is anybody even using the thing and getting value, right? So it's just, to me, it's about prioritizing what actually matters. I'll give you like another example, although not as data. Well, I mean, in a way, data oriented. So I mentioned Year One Labs. One of the companies we were working on, they launched their app, and they South by Southwest. I don't know if you guys remember the name Robert Scoble. Robert Scoble's still around, but anyway, he was doing a lot of media stuff, and I think he tweeted best app at South by Southwest, and it blew up, right? The app blew up. So now you're tracking all the users, and I remember it like exploded in Japan at one point. It was like, right? But then of course that was like a blip, and then usage drops, new signups drop, and I remember the founder coming to me and saying, if we could just get more PR, it would solve all our problems, And so you're watching the data because you get this huge spike and then it dips. And I was like, but the people who got in don't stick around for more than a couple of weeks anyway, whatever the number was. I don't remember, right? But it's like that. Your problem isn't more people through the top. Your problem is over here. So these are just examples of people focusing on the wrong thing. I think sometimes looking for a quick fix, and hoping that the data will just then look better and they can move on with their lives. But it's of course more complicated than that.
Yeah, I actually, it's funny. Johnny was trying to tee us up like there's going to be dissenting viewpoints. I actually think we're pretty aligned because, it's like, what's the old saying, right? It's like when you've got a problem to solve and something you can measure, you can either solve the problem or solve the data, or you either fix the real problem or change the way you're measuring it, or, goose the one number that everyone's leaning on you about in order to make the number go up and make yourself feel better. I think your PR example is really, really good. In the book, one of the concepts that comes up is the one metric that matters, or some people call it the North Star metric. And I'd love to get your point of view on it first. So I've got some specific questions, but can you just walk through it in, for 30 seconds or so for people who aren't familiar with what the concept is?
Yeah. So the principle for us was at any given point in time in your business, depending on what stage you're actually at, there is one metric you can use to focus on. And then all of your experimentation and your work can be against, improving that number to a point where you feel like it's good enough, or the experiments you're running are giving you diminishing returns on that, and you need to move to the next thing. And so it was never meant to be one number fixed forever. Mm-hmm. But really, and it could change at the early stages in particular, that number could change quite frequently, right? Because the frequency of experimentation is really high. The frequency of change is really high. As a company matures, I think the one metric that matters starts to harden. It's like, okay, that doesn't change. Like, we're into revenue now and we're scaling. The one metric that matters probably something that really becomes like a health metric for the business. But early on, it's like, look, you can't fix everything at once. You got to solve one problem. And then again, the key is like, solve one thing just leads to another problem. So then you shift the one metric that matters, then focus on the next thing, then focus on the next thing, and keep going.
Yeah, I thought your maturity model around that was interesting, right? Was it from empathy to revenue and then scale on the mature side? I think, at least for me, with I see founders, they try to pick this concept up and use it, and I'm interested in your viewpoint here. I feel like one of the places people go wrong with this is they think it's the only metric they need to measure just because it's the one thing that matters. Have you seen that too?
Yeah, yes, I have. And then the other, I think, and look, these things are not easy, right? So it's like, it's easy to be like, oh, just track this, track that. It's not as simple as that. But so yes, I think people get, founders, but people are always looking for the simplest framework, the simplest solution. Yeah. Like, please, for the love of God, just give me the answer to the problem that I have, right? So the one metric that matters sounds really cool because, like, oh, all I have to do is focus on one thing. That's so amazing. Obviously, real life is not like that. And so, what we try to help people understand is there is like a health indicator for the business that tells you things are going well or not well. But there are going to be underlying numbers that you have to track at the experiment level, at the at the feature level. These are things that ideally, as one number moves, let's say improves, it bubbles up and also has an impact on the one metric that matters. Because the other problem you see is if people pick too small a number, like, I'm building a feature and I want to track its usage. Well, that makes perfect sense. I would do the same thing. Usage of the feature is, launch the feature, usage is good. Awesome. That feels great. What I don't know is, did anybody buy more? Did it help retain people more? Did it increase ACV? Like, I don't know what it actually did to improve the business just because this one feature is being used. So, picking the fidelity for that one metric that matters, and then figuring out how, a feature or a small thing I'm doing or an experiment I'm running impacts the business. Yeah. That's where the hard work and some of the strategic thinking has to go in.
Yeah, I agree. I think the other vulnerability that I've seen is it's like the lower the fidelity, or like the higher level the one metric is, I feel like the longer the reflex time is, right? Because it's generally like a aggregate or calculated result of a number of other metrics. And so it can be difficult to manage. It's great, to your point, of like a pulse check on what's the health of the company, especially if it's, revenue, which is relatively far downstream, but it's it's one of those things you can't directly manage, right? It's at the very end of a causal chain of a lot of other stuff.
Yeah, it could be. It absolutely could be. I think as the company matures, it definitely
Right.
it turns into that. I think at the, like you mentioned, sort of the stages that with like the maturity model, from empathy, and then we went to stickiness, which is really usage. To me, the one metric that matters can stay in usage for a very long time, which is like, is anybody getting value? I measure value based on usage. I figure out the right patterns of usage, daily, weekly, whatever the case may be. What is an active user? How do I define that? So I think the one metric that matters can stay there for quite some time, which is an actionable sort of thing. Once it goes to revenue, it gets trickier. One of the case studies, we had like net customers, like daily, like net customers on a daily basis was what one company had as their metric. So not revenue, because that's like really abstracted, but they used net customers. So it's like how many customers came on versus churned at any given point in time. So like that's a number where it's still hard to action, because if it's going down, it means people are churning or sales are crappy. Like I don't know where the problem is, but at least I can go and try to figure out where it is off of like a health indicator.
Yeah. You said something else in passing just now that I want to shine a light on for the founders listening to this, because no one shined a light on it for me, and it burned me a couple of times trying to like rally teams around data. You mentioned really quickly defining what the data point is, or I think even more specifically, like defining very granularly how we're going to measure the piece of data that we're aligning behind. It's gotten me so many times. We give things a cute name like an MQL or this or that. And you ask 5 different people what they are.
Yeah.
And one person, it's a demo on the calendar. One person, it's the week the demo is going to show up. One person knows that we filter by a geographic criteria and nobody else knows it, and so it's one of those bits of work that's super unsexy, but like getting to the point where whatever organizational metrics you really care about, actually defining them so everybody knows what we're talking about, I think it's one of those hidden bits of work that can really mess up some
and you see it. I see that a lot in later stage. I'm not talking gigantic companies, right? But even like Series A companies, because now they have departments.
Yes.
And a user or a customer is supposed to flow through the departments, like from sales or from marketing to sales to customer success, right? And they're not actually speaking the same language most of the time. And I do think data can be a common language that everybody should understand, because most of these definitions of things should be relatively easy for people. Like, I'm not talking like hardcore data analysis, just like what you said, Matt, like what is an MQL? Yeah. Like, can we just agree? The one that gets me all the time is active user.
Yes. 100%.
Like that's the one, right? Like what the hell is an active user? And most of the time people really struggle to define that, because they're not even sure the frequency of usage that should drive value.
Yeah.
And so like, if you don't know how many times somebody's supposed to use the product, or how they're supposed to even use the product to get the value, use product, get value, should be ideally a simple equation. Like, how do you measure active at that point? And now we're into an even more fundamental question, which is like, are you creating value? I don't know. Which is like, are you even solving a problem that matters? Like, oh shit, now we're really in trouble, right? So that's
what I loved about your maturity model was like, I enjoy this. Like, I play with spreadsheets for fun. Johnny probably would have beat me up before in high school, right? But right, it's so tempting for people who enjoy this kind of work to grab something that works really, really well for a later stage company and apply it to your kitchen table size startup. It's like trying to kill a fly with a sledgehammer. And so I love that the daily active users or active users example is a great one, because, right, you just heard my slip. Like, you might pick daily active users because you read a blog post that's what Facebook measures. So you're like, well, must work for Facebook. But right, you might be driving massive value for a user that logs in every 14 days, but you've never paused to actually chew on that for a minute, that maybe that's the behavior we're trying to create. So we should be measuring it over a 2-week period. Ben, I want to double click on one thing just to help paint where we've talked at a theoretical level, and I still want to help close the gap for the founder who either are they tactically doing on a day-to-day basis that they say, hey, I'm driving behavior based on this data-driven, focusing on the one metric that matters most. Like, are they over a spreadsheet on a regular basis? Is there a the companies you've worked with to do this best, is there like a meeting where they decide like this is the metric? And if so, what's present in that meeting? Is there some way of visualizing the data? Is it just in a spreadsheet with some traffic lights? Is it on a canvas where we've like drawn out a simple flywheel of where the metric is living right now that matters? Like, draw me into the organization that's doing it well. So when you say, hey, if I could clone how they did this and every startup showed up this way, we'd have more successful founders and more innovation. Can you help like describe it at a tactical level?
Yeah. I think where it starts for me is what I call a systems diagram of the business, which, like sounds maybe more complicated than it really is. But to me, that's, or another way of describing it is mapping the user or customer journey through the whole experience they have with your business. So if you can do a systems diagram, which we did some examples in Lean Analytics, which is, okay, traffic comes from these sources, hits the website. They sign up for a free trial. They activate by doing X, or they become inactive. If they activate, they start using the product. Let's just make that a black box for a minute, right? Okay, using the product, doing stuff. They pay, right? So that's another part of the thing. Or they upgrade, or they churn. And so if you map out that user journey, that's where I always like to start with founders at almost at any stage. It could be early stage, ideally product in market though, because otherwise there's not a lot like to map, right? But so you're mapping customer acquisition, you're mapping how they activate, you're mapping what they do in the product, and how they churn or whatever else happens after. So you start there. And what I found is a company of two people, they will draw a different diagram. So imagine a company, 10, 20, 30, 40, 50 people. Everybody at the company, wherever they work, should understand how the whole machine operates. Things come through here, they do stuff here, they come out here, right? Like everybody should understand that. So it starts with a systems diagram. I've seen this done on a whiteboard, right? Like as an exercise, just to get everybody aligned. I've also seen it in Miro or Mural or a Google Drawing or some other digital format where you're literally mapped the whole thing. Once you've mapped it, you get together with the team and you're like, where is it broken the most? Like, where do we have to focus the most right now? And so that's a conversation of like, again, maturity model and stage. Like, let's just be honest about where we are. And so, an example would be, we don't have to worry about upselling people right now because we haven't even gotten anybody to buy anything yet. Right? Simple example. So to me, it's visual first, like a systems diagram. Oh, that's the machine. That's how, and if I poke here, shit's going to happen over here too, right? And what that allows you to do is like between each step in the journey, there's a metric you can measure. So obviously conversion metrics through a funnel, activation metrics. So now I can sort of map the nodes, the steps, and I can map the metrics. Then I can have a strategic conversation with the team around where is this the most broken? And then we can go and run experiments on that.
Yeah.
Now it's like, to me, then it's a dashboard. And I'm tool agnostic for the most part, right? So I need a dashboard and with the one metric that matters in the middle, like, okay, great, there's other data, but like, what's the one thing we're going to, if we focus here, we run a bunch of experiments here, what's the number that's going to tell us these experiments are working or not working? Right? Mm-hmm. We've increased daily active use. We've reduced churn. We've done something. Then if I get that to a level that I'm happy with, and again, how to define happy on that, I have to look at benchmarks online. I can talk to peers, talk to my investors. I honestly, I think to some extent it's like diminishing returns on experiments. I've kind of hit a level where I'm like, shit, I can't get it any higher than this or lower than this. I'm just going to move on. But then the map lets me say fix problem A, then logically people are going to get to step B and I'm going to have to go fix. So systems diagram, simple dashboard. Again, that could be any format. But to me, the getting everybody understanding the same thing is really the key. Like everybody should understand how the business works. And it's shocking how often that's not true.
Yeah. Man, I could not agree more. I can imagine working in that environment. I love how you drilled that down to a tactical level. I want to share a methodology that we've been working on and get your thoughts on this. Okay, so we talk about the growth ceiling for a SaaS company. We're typically working with a SaaS company somewhere between 100K in annual revenue to 10 million in annual revenue, but the bulk are between like 100K in annual and 2 million. So by most people's definition, it's still pretty early stage. Mm-hmm. We see three main levers, right? The churn ceiling is how many customers I'm acquiring. What's my churn? How much are they worth? And we can kind of plot when is the business going to hit the ceiling. And what we're working through is you plug in the numbers, see the ceiling. And then, so now we got to decide which lever is most impactful for us to work on. And of course, under each one, if I decide to work on acquisition, there's like 10 more levers that we have to consider. Is it traffic? Is it conversion? Whatever. Regardless, we just say the first layer we've got to peel back is to figure which one of these three. So then we move into a almost like an impact, confidence, and ease. Like how confident are you that you could, if we could fix your pricing and make customers twice as valuable as they are, right. What's the confidence level you could have on that? So if we put in, what do we think we could do and how confident are we? Now we can chart and say, okay, well, based on those inputs, we should focus on acquisition first. Is there some parts? It sounds like the answer is yes. There's some parts science, and then there's also, now I have to take into the stuff that doesn't make its way into a spreadsheet of like how much more challenging is the next increment of improvement. How I guess to sum my question, how easy is it for you to drive consensus in the organization, or is there still some like, it may not just be a single metric that matters, it could be 2 or 3, and we just got to pick the one that we want to focus on most right now? We have the highest degree of confidence. There's some low hanging fruit in this area. We can make quick work of it and come back and tackle number 2.
Yeah, I think the one metric that matters is like both. It's something I think people should really try to get to, but also a message of simplify the data and simplify the decision making. So like, would you ever eliminate tracking everything just to say, let's pick one number and roll the dice? No. But instead of getting caught in sort of an analysis paralysis with the data you're collecting. So I think what you're talking about here, Johnny, for me is like, how do I prioritize? And prioritization is hard. So I think, what you've described is a good way of thinking through that. I think there's always an element of like confidence is an element of gut. Right. So that's going to be pattern matching things I've done before where I'm like, oh, yeah, at another company I was at, we figured this out and it was actually churn that was the killer. And so we lowered churn and then that gave us, let's call it permission / the ability to go acquire more customers. Yeah. I think to some extent, some of it's logical, and the systems diagram model of it helps you sort of take a step back and visualize and be like, where are the hot spots here? I think founders struggle with the idea of like hardcore prioritization because it's what if something else is the right thing. Yeah. So now we're more into you got to use your gut sometimes and you've got to keep the experiments short. So I think that's the other component to it, which is, look, we're prioritizing so we can execute work. We're not prioritizing because we're 100% sure we're guaranteed to be right. So I get nervous. Like I've seen companies run experiments for like months, and I'm like, I don't know. Like you better be right at that point. But if you tell me this is going to take 2 weeks to do, it's like, what the hell? Like, what's the worst that could happen? Like we're wrong. fine. We invested 2 weeks. We probably learned something. Well, we learned something. We were wrong, and maybe out of that, a better experiment idea, a better prioritization approach emerges, and that helps us. So I think prioritization always hard, but easier if you're doing things quickly.
Yeah, it's so interesting. When we run founders through this growth ceiling, the visualization, 50% of the effect is actually seeing the numbers and taking a data-driven approach to what we're picking. The other half of the impact is just in that they have counted the costs or the opportunities and the other things they could be focusing on. And rather than trying to make the right decision, they now have the confidence to just go make the decision right. Oh, I decided to tackle pricing. That means I'm not focused on churn and on acquisition. Right. We are just going to nail our pricing optimization in this next sprint. And I found that commitment, the ability to set down the fear of missing out on having focus on another opportunity is just as impactful as picking the right thing.
Agreed. I totally agree with that. Yeah, I totally agree with that. And I would say, like, in my experience, and you guys have probably seen this also, like, as companies grow and they raise more capital, they hire more people. That's usually what folks do. And then those people get a bit siloed, and then everybody starts chasing their own priority. And then eventually the founder or founders, X number of months later say, God, we're actually going slower than we were before. I think it literally happens every single time. So I don't know that talking about it fixes it, but nevertheless, here we go. And that's too many people with too many priorities, all trying to be successful. Nobody's trying to kill the business, but they're all chasing their own things, and they go like this. And that, I've seen that kill companies before. Yeah. And so, to me, it's like the key is just pick something and go, and then do it fast, do it well, learn from it. And if you're wrong, fine. But when you get 100 people and they've got 20 priorities, then you're probably doomed.
You back? I think we lost you there for a sec.
A little frozen. Yeah, a little frozen. I don't know what's going on.
The last part you mentioned, or the last thing I caught was like when you have 100 people and they have 20 priorities, and then it cut off.
Yeah, what's going on? Oh, wait. You guys there?
Yeah, we're here. We got you.
Okay. Yeah, all I was saying was, when you've got 100 people and 20 priorities and everybody's running in a different direction, that almost always ends in some version of failure. Yeah. So to me, again, like the goal here, use the data that you have, but at the end of the day, making a decision on what to go chase is the most important part of it. As long as that's doesn't take that long to do. Don't make 6-month long commitments and then be wrong, because then you've probably killed the business.
Yeah. I love it. So we're talking about speed, and I feel like you could sum that up in like not forgetting to behave like a startup, but I'd love to switch gears and talk about the earliest of startups and what you're doing in the venture studio world, right? One of the reasons I was really stoked about this episode, you get your hands into so much stuff, man. It's a lot of cool places we can go. But I think a good point to start with on this for our audience, can you just walk through at a high level, like, what does a venture studio do, and how, like, when would a founder want to work with one? When is it a good idea? Maybe just set the table, and then we'll go from there.
Yeah, I think I'm going to say, like, my definition of venture studio, because it is one of those terms that is now means a whole bunch of different things to a whole bunch of different people, and that's okay. That's fine. Like, who am I to be like, I don't own the term venture studio, but for me, it's building and funding companies from zero. Mm-hmm. So you got to be able to build them, and you have to be able to write a check. So it's the combination of those two things from zero, which is the day one. So that's how I, like, at a high level, that's how I would define it. you're seeing studios that are more on the build side. So, folks like dev shops, software companies, like product studios that are rebranding perhaps as venture studios, because that term is having a bit of a bit of a moment. But for me, it's the building and the funding from zero. So that's how I would define it. The methodology by which you do that, that can of course vary, and there's a whole bunch of different nuances inside of, okay, well, how do you go about doing that? But to me, that's the fundamental.
Got it. And what's the prototypical founder that you end up working with? First time, second time, some type of experience? Like, who do you look for?
Yeah, it's been a mix for us, so, and other studios will have other sort of parameters around how they define it. Most, I would say, are looking for repeat founders. Mm-hmm. That shouldn't be a terrible surprise, because that's what everybody is looking for, including investors. Yeah. So most of the time, people are looking for repeat founders. We've done quite a bit with first-time founders, not exclusively repeat founders. But so for us, it's a couple of criteria we would look at. One is if you're a first-time founder, we need you to be an expert in the space or the vertical that you're going into. Like, we can't work with a founder who says, I want to go, solve sustainability because I care, but I know nothing about that, right? So right. First-time founder, you have to be a domain expert. That's often like a veteran of an industry. I've worked 20 years in banking. I'm sick of it. I can't handle it anymore. I've seen all the problems. I got to go start a company, but I've never started a company, but I know the industry. Maybe I've got some money set aside so I can kind of afford to take a swing. So that's one kind of version. The other is the repeat founder, been there, done that. And those folks you can put into an industry or a vertical where they may not have experience, but they understand what it means to build a company. For us, it's typically a solo founder, but not always. So, often it's a solo founder to begin the journey. And then we're typically working with founders for about 6 to 9 months. During the course of that time, we're bringing in, often it's a non-technical founder, and then we bring in a technical founder once we know what we're actually building and what we're doing. Yeah. So we like them to leave the studio with a team, but often it starts with a solo founder. And what I would say is these are age doesn't matter really, although I mentioned experience in one thing. I think studios have an appeal to more diverse founders who don't have the same level of access to stuff that other folks would have. Like, if you can get into Y Combinator, a venture studio probably doesn't make a whole lot of sense to you. But there's a whole swath of potential founders that don't have access to that, or don't live in the Valley, or don't know a ton of investors, or didn't do an MBA at a top school, right? So that's another component of the founder profile that I think studios are a good fit for.
I love that. And can you walk through, on average, I know that's probably a spectrum, but like on average, what does it look like? Like, what kind of check sizes is a venture studio putting in? What's the equity breakdowns look like? Or ask the question more directly, what is a founder gaining and giving up by working with a venture studio?
Yeah. And it does vary a lot. And so my advice to anybody listening who's looking at studios is do your homework on the studios themselves. Like, really research them, understand what they do, look at their portfolios, talk to founders that they've worked with, because that'll be the best reference that you can do. So you got to do your homework. Generally, what we see are studios are taking 20 to 40% is kind of the range. On the 40 starts to get pretty high for me, like personally, like I find that a little bit on the high end. But 20 to 40%, some will be a little bit lower than that. That will be a combination usually of sweat equity, i.e. some portion for the services that you're going to receive. Those services can vary. And then a portion of that should be for capital as well. Mm-hmm. Again, this is where I think the capital piece becomes really important. If you're getting $0, but you're getting just free service for equity, it can get sketchy really quick. I'm not saying the studios that do that are all bad. I'm just saying it can get sketchy really quickly, right? Naive founder, maybe a first timer, never done it before. All of a sudden, somebody comes along and says, give me 20% of the company. I'm going to create all this value. Money talks at this point, right? So combination, the amount of money varies quite a bit. So, I would say it's typically it's going to be $150K, $250K first check in. Some will go up to $1 million, maybe even more. If they have a fund structure, they might be doing like $500K, and then let's get this thing to launch, and then we will follow on, right? So they could have a follow-on structure depending on the funds that they have. So that's high level. I can give you Highline Beta's numbers quickly. By the way, our numbers have changed on almost all our deals. Like, I've never found one perfect model. Yeah. So we still iterate on ours, but we're typically about 10% on the sweat equity side. And then we're putting in, call it about 250, company. We incorporate the company. Yeah. Open up a bank account, put about 250 in, let's say, right? Sometimes a little bit less than that. Depends on the needs. Maybe there's friends and family at that point they're putting in. We don't want to over dilute. So we typically are around 18 to 20%. And then we will follow on. Usually we think about that, like, let's get this thing to launch, get the product built, get it to market, get the initial traction. And then we'd put in, let's say, another 250. So we're kind of the first 500 of $1 million pre-seed is kind of how we think about it. But again, there's there's variables there.
Yeah. I've done quite a bit of, it's a model that fascinates me and has for years. And one of the foundational, I guess, differences of opinion that I've seen out there on the interwebs from venture studio founders is the right way to pick the idea, pick the founder, and match them together. And I feel like there's really two schools of thought on this. The first one is, we're going to incubate the idea internally, maybe do some super early validation, and then go search for the right person to be the quote unquote founder to drive the ball forward. And then I think the other school of thought are the people who are interested in the person bringing their own idea, probably with the thought that the psychology is going to be a little bit, be more strongly bonded to your idea because you came up with it. So I'm curious, do you have a preference? Do you guys create the ideas and find the founders? Do you want the founders to come with the ideas? Like, what are your thoughts on what works best?
Yeah, we do both. That's the simple. There's two schools of thought, and I'm in both schools. That's how we do it. So we've done both. Mm-hmm. We have a third element to ours, which is, in some cases, we're working with big corporate partners. We're validating the opportunity with them and then spinning it out. So off the back of the work we do with a big company, where part of that thesis is let's leverage the assets they have: customers, data, capital, domain expertise, industry access. Can we leverage those assets to build net new companies that are benefiting from the corporate partner that helped instigate? So in that case, it's sort of us doing the work first, but with a corporate, then finding a founder. We do our own validation work in certain areas that we're interested in, and then we'll look for a founder. In that model, we tend to do that very quickly. So this is where it's kind of like in the middle between founder with an idea and us with an idea. So some studios will do like a year of validation work, then bring somebody in. And arguably at that point, they're bringing an operator in, right, which is fine. Like if that's your model, so be it. They'll definitely take more equity in that case. If we're chasing something on our own, I would like to bring a founder in within 3 months. And the argument there is kind of like, look, we've done something. We have some instinct that there's something here, but we need somebody to pick this ball up and run with it and own it. And that's why we tend to give the founder most of the equity in the company in exchange for the fact that we haven't done an enormous amount of work. I also think if you do a year of validation, you're still probably wrong on any number of variables anyway. So you're still making a bet on the founder's ability to win. So at that point, you might as well just incorporate faster, put the money in and run. So corporate, we do our own, but we also do look for founders who have started to do their own validation work. And I describe that as like a founder that's almost ready to jump off the cliff, but not 100% ready to jump off the cliff, and we'll jump off with them. So we do all of those. And it just depends on any number of like the situation at the time.
Cool. I like it. I like where you're at about the good idea is the good idea. Let's figure out the specifics around it, right? But you're optimizing for the quality.
Yeah. And if you look at and by the way, if you look at our portfolio and I were to go through like company by company and say, this one we incubated, found a founder, this one founder came to us. First of all, our portfolio is quite young still, right? So like TBD, but off air, if you ask me, like I think it would be a mixed bag. I'd have to go one by one and be like, oh, we incubated that one. Like we've done 18 investments. 9 of those have been companies we've built from scratch. 9 were just flat out pre-seed investments. Of the 9 we've done, the one that we did with a corporate partner, then recruited the founder, was our first exit.
Cool.
So TBD on portfolio performance. I think I will say this, like, I think if you bring the founder in early enough and they really are passionate about the space and you know that they're probably going to pivot later on anyway, I have not been overly concerned about how invested that founder is. You know, the argument of like, oh, it wasn't their idea. They didn't dream it up, so therefore they don't care. I call BS on that a little bit. If it's the right person with the right mix of ingredients and they have the right upside and incentives.
Yeah.
So there's a few ifs there, but it's just not black and white. Like, find me a formula for building successful companies and we'll just all do that. But since it doesn't exist, we'll just make it up as we go.
Yeah. Ben, I heard you say in a recent podcast that you prefer investing in the company as early as possible because it takes away from the only successful outcome being that they're a unicorn, they reach massive heights. That you actually get to participate earlier, and even is your model that, you know, when they raise the next round, do you exit your share of the company at that point? Do you get to decide whether or not you stay on and after? I thought it was super interesting that you had to avoid the need for you to go, you know, 1 for 100 on these like big swings. And it still makes sense having, you know, the 99 that don't work out. It sounded like you like playing a role much earlier on, and that even that next round of funding represents a great win for the venture studio. And it doesn't mean that the founder has to come in dreaming up $100 million business idea. Is that, first off, feel free to correct me if I'm wrong, if I haven't articulated your point of view correctly. And then does that say more about just your enjoyment of that stage of company, or about what you think, you know, a later stage VC, the pressure it puts on the business and the founder and just the model in general?
Yeah. I'm glad you asked about the enjoyment part, because honestly, I can't imagine being an investor. And I say that, and then we'll talk in 10 years. I'll be like, yeah, now I'm a Series B investor, but I don't think that'll happen.
Like, you reserve the right to change your mind. All good.
Thank goodness. But I love the 0 to 1. It's almost all I've ever done. And so I can't imagine being a Series A, Series B, Series C, like later stage investor. It's like too much math, honestly. So it's not exciting. I like the creation of stuff. It's why we started the studio in the first place. Was like, I love investing in founders at the earliest stage, because I love helping other people achieve their vision. But I also like building companies. I don't like just sitting there sort of writing checks. And I think that creates a weird dynamic, right? Like, oh, I have all the money, you have no money, and therefore come begging for money. It's like just a shitty experience for everybody. So I like building too. So the enjoyment part is a key. I think the answer to the other part of the question on the sort of the outcomes and the math, for us, we think about it as optionality. So probably don't try to get out on the next round, but I would say at the Series A level, if there is an opportunity for a secondary or to sell a portion of our shares, we would look at that, because at the end of the day, our job is to return cash to our investors. And so like we have investors, they want a return. And so if we can get out a portion early, we would certainly look at that if that option is available to us. And because we own, let's say, a disproportionately high amount of equity, compared to maybe like certainly more than an angel would own, right? Like if you're writing angel checks and you own, I don't know, like 1% or below, we own, let's say, 18%, some in common, some in preferred shares. And so do we exit the common stake at that point? So that amount of equity that we own affords us the opportunity to maybe get out early. It also means that if there are early exits, those can still be material from, again, a cash on cash return basis. Yeah. Now, that doesn't work if our fund size is gigantic, right? Like if we had I don't know what gigantic would be, but even a $100 million fund, which is actually not gigantic, but let's imagine for a moment we had a $100 million fund. You can't early exit your way to big returns. Like you better hit some bloody gigantic home runs, right? But we're not necessarily playing an assets under management game. I.e., like we're not trying to grow a $100 million fund on management fees, then a $500 million fund, and oh crap, now we need $1 billion fund. So we play a different game, which allows us to generate return off early exits. And again, that's all just optionality. If we see something that's going to take off and we want to ride it, we'll ride it. Like I have no problem. Like we need some big wins too, right? You can't $5 million to $10 million exit your way to victory here. You got to have a couple of big wins as well. But again, optionality to make those kinds of choices that are good for us, good for our investors, good for the founder also. I'm just super founder friendly. Or at least I think I am. I'm saying that, but like ask my co-founder and he'd be like, Ben, you're too founder friendly. I'm like, yeah, because I was a founder and it's fucking hard. And so if we can help them, like a $20 million exit for somebody who owns 60% of a business is life-changing money. Who am I to tell that? No, don't take that. Let's ride it. No, man, take the money. Like take the money, I mean,
you and I see eye on that one, man. I love it.
Yeah. Yeah. This is an interesting component you have when you're incubating or when you have an idea you want to go chase down, you're hiring someone who is essentially going to be a founder, right? Yes. Like how is that job description written up?
Yeah.
And where do you find them?
Yeah, no. So you know what? A couple of different ways that we've done it. Often what we do is we call it a founder in residence. And we say, come in, work with us, let's say for about 3 months, and let's date. I think of that as a dating period. You have to like us, we have to like you. So we're dating, we're also dating the idea, right? So it's a bit of a three-way situation. And so we do that and we hire them as contractors basically to start most of the time. And then we get to this sort of no-go decision, which is, do we really like this person? Do they like us? Do we want to work together? And do we have enough conviction in this opportunity? If we really like the person, we've invalidated the idea. We'll just go chase something else with them. If we don't like the person or they don't like us, we just break up and we move on with our lives, right? So that's part of it. Like you can't do that with 100 people to get one business, right? You have to be pretty good at like that. It can't be a really sharp funnel. Yeah. Because otherwise you'd just be killing yourself working with folks. And then on the recruiting, it's by any means necessary. So this is mostly network, mostly referrals, but we've done job postings on mostly LinkedIn as well. And that that's my like shake the tree strategy and see what falls out of the tree, right? Because as the popularity of venture studios goes up, and in our case, like as Highline Beta's brand gets bigger and more well-known, you put out a job posting, we're looking for a founder in residence focused on enterprise insurance, you are going to get good quality candidates. Just, Ben, what are you doing? What's going on? And that's, so recruiters, like some studios use recruiters for this because they, you just need so it's like any means necessary to recruit. We get it wrong a bunch. Like that's totally fair. Bring somebody in who's excited by the concept of a venture studio, but then they don't fall in love with the idea, and they're just like, I don't have the stomach for this. Like I can't dedicate the next 5 to 10 years of my life to this thing. I'm like, I totally get that. And then we would have to go look for somebody else. So it's a real mishmash.
Yeah, it makes a ton of sense. I like we recently started using a term that we learned from Jason Cohen over at WP Engine called a tour of duty for like certain promotions or new positions inside the company, where we're like not 100% sure that this role is going to continue to exist or this is the right person. So let's put a label on it that makes if we decide to pivot from this idea, keeps it from feeling like failure and more so by design, that it's one of the two outcomes we think is going to happen. And in some scenarios, it's actually more likely than it actually working out. So let's make sure that we can all be friends and we minimize the shrapnel if we do have to go a different direction. So I love that. I also want to unpack so in SaaS Academy, we have about 70% of our clients will be first-time founders. They've got some vertical experience. I would call it a traditional founder path. Right. The other 30% of people that we've worked with, they come from from agencies or from service-based companies or from more established companies, and they're trying to either incubate or spin out a SaaS product. And failure is way more common than not in those, not because they were bad ideas, but because it's so challenging for them to actually dedicate the right person, energy, etc., to the new thing when the main thing works so well. Like no matter how bad an agency owner doing 3 to 5 million wants to get out of the agency and spin off the SaaS product, they can just never quite feel confident enough to make the leap. And so it just keeps getting all the leftover time. But you have a whole half of what you're doing at Highline is focused on this side, or maybe it's not half, but it's enough for you to say there's two parts of the business, and one of them is incubation side. So what have you learned about the corporations that successfully do this? What's true inside that company that is absent from the ones that have just a graveyard full of great ideas that never came to life?
Yeah. Oh my, it's so hard to do what you're describing from the agency. And funnily enough, my first company was a web agency I started in 96. So it was a long, long time ago. Built a web agency, small. We were acqui-hired by a bigger web agency in like 98. And, chugging along. And then we see .com crash coming and we better find another way to make money, because all these crazy .com projects are going to disappear. And this is a day when building an e-commerce website, by the way, was like $400,000. Whereas now it's $29.95 per month, right? Like just bonkers. So we actually pivoted from agency to software company. We built project management software and started selling that, and people were actually buying it, but balancing both. Like I live that experience. It's so brutal. And like we did pivot completely to the product, but it never grew that much. So I wouldn't even say that we did it that successfully, but I've lived that experience. And it's really hard. To some extent, we live that experience, like you said, like today, because we have an agency model, right? That's a consulting business. That's how it generates revenue. And we have a studio where we earn equity. So one generates revenue, one generates equity. We had to build it up to a point where we had enough dollars that we could have a separate team dedicated to the studio. So like, this is a long-winded answer, but that's where we had to get to. But it was also always our mission to build and fund companies. So it also took us a couple of years to raise a venture capital fund. So we started the business. Let's just generate revenue. Let's pay ourselves something. Let's hire people. Let's grow revenue like any agency, but always with the intent of building companies and investing in companies. But we had to get the fund in place and other things, and then have enough revenue we could hire people. So if you're running an agency like what you described, like $3 to $5 million, you honestly, like, it's almost impossible to dedicate the time, because you can take this work on for $100, or you could spend $100 building this thing. You're always going to pick the $100 from revenue. So you can do it by dedicating people to it. You can do it by pulling the chute, right? Just like, that's it. Here we go. Like, give up the service business. The other option, I think, and again, depends on your setup, is hire somebody to run the service business, which is tough for agencies to do. But actually at Highline Beta, that's in part where we got to. Like, we put somebody in charge. Her name's Paige. She's been with us a long time. And we put her in charge of the service business, basically, and said, like, look, I'm still involved. My co-founder's still involved, of course. But we said, look, I can't run that and run the studio and raise capital. We just can't do all those things. So you're better at this than we are anyway. So you can level people up in the org to take over parts, so you can go commit over here. But I mean, that sounds easy, but it's obviously very difficult to do.
Yeah, the service-based one is very common. I've even seen it, and I'm curious of the ones that you have even bigger. Like, we work with a company that did close to 80 million a year, and they had 4 or 5 people assigned to a tech product, and they had already put in more than $500,000 into the product itself. Right. And even still, like, they have this kind of internal CEO of the product. And even still, it's very, very difficult. We've tried putting the label on the bottle to say, look, these things have to be true. A person at minimum has to be accountable for the success of this project, and nothing else inside the company. Anything else inside the company, it's going to keep on getting focus. I'm curious if you've distilled a couple of principles that you say, like, when we're working with a larger, more established business, these things have to be true in order for us to even have a chance. There's already enough. Once you get the people in the room and try to go launch a thing, is already enough. But now you add this additional headwind of that there is a known path to creating profit that oftentimes has a lot less resistance than the new one. The new one might have this interesting ability to disrupt the main business and becomes a new thing. There's situations that it could be a whole nother business and something, a sellable asset, lots of benefit to it. But sometimes that 0 to 1 inside the bigger company is more challenging. When you've seen it work, what were some of the patterns that you even look for now? I'm sure you have to decide at Highline, when do we dedicate resources to something or not? When you're talking to these prospective, established companies, what gets you excited? And then what is like, I'm aware of where this ends. They may not be that, but this isn't the right one, not the right one for us.
Yeah, even with big companies, like, small agency, you have sort of a lack of resource problem. As the company gets bigger, it's not necessarily a lack of resource, right? We have a person dedicated. There is a budget. We still can't pull it off. That's a combination of things. Sometimes it's honestly the talent. It's just not the right people to do 0 to 1. If you're an $80 million business, there were founders, and maybe they're still operating the company, and they remember what 0 to 1 was, but they didn't necessarily hire a whole bunch of 0 to 1 people. We've seen that in big companies, right? Like, our clients tend to be multinationals, super talented people, super smart people. They're just not 0 to 1 people. And so taking a high performer from a bank and saying, you now are going to go build startups, high performance over here doesn't mean high performance over here. So talent is one of them. Often if companies are trying to systematize this sort of like corporate venture studio model, we encourage them to hire from the outside and balance it. Like, imagine you have a team dedicated to building new ventures. Half of them should be internal folks, so they understand the machine. They can call in favors when they need them. But half of them have to be from the outside, more entrepreneurial, who are like, I want to leverage these assets and punch a hole in that space. So talent is one. I think the way capital is deployed is also broken in most of those models. So most big companies, $80 million company also would be probably the same way. Annual budget. And like, that makes sense. We can plan, right? Obviously gigantic companies, like, they plan well in advance, like what they're doing. But 0 to 1 startups don't work that way. And so you don't have the right budgeting mechanism. So it's like, okay, I need to know exactly where we're going to be in a year and budget that. So I'll over budget probably hire more people than I need, because if I don't, I'm not going to get the budget. And then if it starts to take off, well, shit, there's no more budget, so I can't grow now. Or if it's going sideways, I'll pretend it's okay, because if I tell them I don't need this budget, they won't give it to me next year. So it's not budgeting this is where an investor mentality helps, which is, okay, I know this is not a spin out. I know this is not an investable opportunity, let's say for a company like Highline Beta, but let's put an investor mindset on this thing. What's the smallest amount of money we need to get an MVP in market? $50? That's what we get, $50, right? Let's ignore salaries for a moment, right? $50, great. What's the next stage? Traction. So now it's just going back to those basic principles of good 0 to 1 execution, but also the mentality of, oh, that's kind of like a seed round. So the deploying of capital is also often out of necessity, the way they deploy capital, not the right way. The last part here, and this one's really difficult, is incentive models. So incentive models in big companies are obviously not the same as incentive models in startups. Startups, you're doing it not for a big salary or the benefits you get or the 401k, you're doing it for the upside. And in new ventures inside of a big corporate entity, there is usually no upside. And so that's great because you have the security of working at a big company, but you have none of the motivation to grow that thing materially. And then the other unintended consequence is big companies never fail. Obviously, big companies fail all the time, but they never fail, right? Like they spend millions and millions of dollars on stuff that doesn't work, and it just gets swept under the rug. Maybe somebody loses their job. But unlike small startups that are like experiment, fail, learn, experiment, fail, learn, on and on and on, big companies don't operate that way. So now you've put somebody in charge and said, you go do this, knowing that 80% of the time you're going to fail, on the chance that 20% of the time you're going to get it right. The consequence of that is that employee thinks to himself or herself or themselves, I can't fail. I have to build a business. So now they just execute some nonsensical plan to make it look like they're building a business, right? If you tell people you got to go do that thing, God forbid you'd come back and be like, that was a stupid idea. I invalidated it. And a big company rarely understands how to accept that, or I don't like celebrate it, but accept it as part of the journey. So those are anyway, again, a long answer, but those are the components that make it very difficult. Now it's doable. I love seeing companies try to incubate new things. And I think every big company needs to try to build their own stuff. They also should be looking at investing and acquiring, like all the tools in the toolbox. Yeah. But those are some reasons why building in-house is really tough.
It's funny because it takes me full circle to something you said in the very beginning when we were talking about data and lean analytics, which is like making your small bets on a 2-week, 3-week, 4-week turn and not a 6-month bet. And then you look at the large company who's only making bets on an annual turn when they do budgeting. And it's a total mismatch.
It's the same thing. Like the ways of working are just so radically different.
Yeah.
And I think they understand it, right? Again, people who work in big companies are not stupid. They're super smart. They're super successful. They built a giant thing, or they're part of a giant thing. They run a P&L much bigger than any P&L I've ever even seen. So these are really effective people. But then 0 to 1 is a totally different game. And there's so many missteps. Again, maybe not colossal failures, but so many missteps in that process. And they can talk about innovation that way and say, we got to, apply lean startup or design thinking or jobs to be done. But talking about it or understanding the framework and living it are very, very different things. And and then the last thing I'll say is they're not comfortable with portfolio management the way like an investor would be. So to me, the idea is, if I'm a big company, I've got to start a lot of things. And two things I have to realize. One is many of them will fail. And then the ones that work will still take years to work. So if I'm trying to do this to juice my top line next year, I'm going to fail. I've had conversations with companies where they'll say things like, we want to build a corporate venture studio, or we want to do something because I'm being tasked with generating $200 million more in revenue in 5 years. I'm like, well, that's a very ambitious goal, very exciting. I'm like, you should just go buy a company that makes $20 million a year right now and juice it 10x, because you're never going to incubate enough little things to generate $200 million in 5 years. Like, what are you talking about? Like, that's a unicorn on top of a unicorn. You know what I mean? Like, I'm talking revenue, I'm not talking valuation. I'm talking actual dollars. 200 million 5 years. I'm like, you better just go buy something right now to get there, right? So portfolio management, patience, these are also things that bigger companies struggle with, especially public ones, because they got earnings reports to do. So
it's interesting. I have a specific question on this, because this just the paradigm between big company thinking and 0 to 1 thinking always fascinates me. How do you, what advice would you give to a big company who's struggling with the tension between, I want to start something, should I build it as like an internal tool and try to spin it out later, or should I focus on the market opportunity and, you know, the Venn diagram sits where it sits, right? Like, how do you see companies try to reconcile that?
Yeah, I mean, the simple answer is hire Highline Beta first, and we will solve all of your problems. So that's our tagline, right? So that's right. Yeah, and can't edit this piece out, right? But the way I think about it is, so big companies, like really big companies, will often have an M&A team, like a corp dev team. Sometimes they'll have a CVC, a corporate venture capital group. They'll have any number of innovation teams as well. And they all unfortunately work in silos, typically. So the M&A team is tasked with going and acquiring some businesses. The CVC team is tasked with investing. The innovation team is tasked with building. I think the better way of doing it is, let's go validate the opportunities in the market first. So right back to the first principles. What's the problem? Who has it? Is the problem painful enough for people to buy or use, buy with their money or their data or their time? Do we have a right to play / win in this space? And then what's the right way of doing it? So if we believe there's a big enough problem, we believe we have a right to play or win in the space, we believe the market is interesting enough and strategic to us, and we believe we can build a solution, it's feasible for us to do something in the space. Sometimes there are regulatory, compliance, legal issues there. Now, what's the right way? Build, buy, partner, spin out, or invest. So to me, the best case scenario is a small team. It's like a black ops team. Their whole job is to validate problems and then strategically figure out if our company, let's say whatever company you work for, has the right to play and win in that space, and then decide what's the right way of realizing that thing. So, while you're doing that early discovery into a problem or an opportunity space, you're also looking at the competition. You're looking at where the investment dollars are going. You're looking at the startups in that market. That's giving you a lens into, why build it if we could just buy it? Or why buy it if we could just partner with it? So it's sort of like, start fundamental principles, validate, and then make a decision about how to realize it, as opposed to, I'm just tasked with buying stuff, so I'm just going to buy stuff. Or I'm tasked with investing in stuff, so I'll just invest in stuff. So it's just a different way of organizing that work to try to get to using the right tool for the right job.
Makes sense.
Ben, you have shared a tremendous amount of content on just over the years in general. You're a great follow on Twitter, LinkedIn. You write a newsletter called the Focus Chaos. Some great resources. In fact, call out to the earlier part. One of the things that I had found on your site prior to our call was the deconstructing and mapping the business system. So there's great examples if someone wants to see a visual example of what you were sharing. Great free resource, ungated there, which is cool. I'd love to hear, how are you? Is this a creative outlet for you that doesn't have to turn into anything, or are you applying some of the lean analytics methodology, and does this grow up into a business well, I'm sure it helps in many parts of your business now, but I'm curious, like, what's the primary intent behind what you're creating with the newsletter and Focus Chaos?
Yeah, number one for me was I genuinely enjoy writing. I find it challenging to write well, to codify thoughts. So I just enjoy doing it. So I launched Focus Chaos last December, I guess. I was like, I'm just going to do it. It had been a while since I had been writing stuff, and part of it was was having now run Highline Beta for almost 8 years. I was like, man, venture studios are getting popular. People are talking about this a lot. I've run one for 8 years. I think I have a perspective that could be interesting to other folks. So mostly enjoy writing, enjoy sharing, helping others. Genuinely enjoy that. Then the other part was just back to experimentation. So I was like, I'm just going to use Substack. What the hell? Let's see. I haven't used, I was like, I don't want to use WordPress, too complicated. I want lightweight. Like, let me just experiment, So I was like, partially that, just experimenting with stuff. And then I think third is, I think the brand building exercise around something like Focus Chaos does help Highline Beta. So strategically, there is a good fit there without sort of trumpeting Highline Beta, Highline Beta, Highline Beta, and being salesy about it, with not my strong suit. Doing it through something like Focus Chaos, it actually does help. And then LinkedIn, of course, more than X or Twitter, really is where the audience is for a Highline Beta or myself. So fun, like doing it, challenging, experimentation, there's value. I never had any intent of turning Focus Chaos into a business, but I think a lot about, I just haven't done anything around experimenting with monetization just to try. So actually one thing I just launched was a job board for venture studios.
I saw that. That's cool.
Yeah. And I was like, because you know what? People started coming to me and saying, how do I get a job at a venture studio? I was like, that's a good question. And then I wrote a thing in the newsletter about it. And then more people started asking me. And I was like, that's a good question. Back to some of the earlier conversation, they're all different. How do I find them? I'm like, what the hell? Let me launch a job board. So found some software, launched it in a day, put a paywall on it of $25 per job posting just to see if anybody would pay. Some people have paid. Most people don't want to pay because there's no traffic, but that's also experimentation. So not really to build a gigantic job board empire, but I did run a company in the recruitment space many years ago, which was a failure. And so I have sort of some PTSD around that. And so the job board is a bit of an outlet. So again, a long-winded sort of story, but no grand plan to really monetize Focus Chaos, which is why I don't gate stuff. But I may someday turn monetization on just to see what that experiment is like. I'd be curious to see, but there's a limit to how much content I can create. So,
that's what had me asking the question. You have your hands in so many, you have, a lot going on with the portfolio you have, and the methodology you've taken. It'd be one thing if you said, hey, I've got a fund and I write checks, and so you're evaluating deal flow, but like you're in at the most challenging stage of a business, actively taking on a co-founder in a high support role, yet you're still producing content. And I think Matt and I have been individually on our own kind of swan dive into creating content more frequently, and through that I've gained a real appreciation of have convinced as many of our founders as possible to go do the same, because the founder-led brand is really it's incredibly powerful and compelling compared to the more salesy approach. Like just, show your work, talk about how you're doing this. And so, but we oftentimes get to, I'm early stage on the one business they're running and they don't have enough time to create content yet. You've got, your hands in a handful of them and you're still creating content. So wanted to ask about the why you felt like it was important. And I think there is an element of find the version of it that produces energy, that is exciting for you. There's an element of the writing side you said helps clarify some of the thinking and you just take joy and satisfaction in, which I think it shows through in your work, man. It's like really good stuff.
That. It's also, by the way, very good for networking. So that was the other one, as you were describing it, Johnny, like founder-led marketing, which I agree with. Very good for networking. And, since writing Lean Analytics, like there's been so much more amazing quality content, great operators and practitioners sharing their processes, their benchmarks, how they think about things, like a real evolution of stuff. And I was like, I got to get back in the game, if you will, of connecting with these thought leaders and influencers and people trying to collectively move the tech industry, let's say, forward. So part of it was also just reconnecting and meeting a bunch of really interesting people in my business. Like I often say, it's really just the business of connecting dots. And you kind of never know when one dot will connect to another dot. So unlike running one startup where you go super deep, I'm more shallow in more things, and that means more dot connecting, which means got to make more connections, got to meet more people, and I'm pretty lousy at networking in person. So for me, networking online through content is my way of connecting with folks in a meaningful way.
It's creating in its most, like it's a through line in all of what you're doing, right? If you think about it, if you want to be great at creating value in our society, like we can do that and by creating businesses, which have so many little things that have to fall in place. You could also take the time to sit down and write a really well thought out blog post.
Right.
Or article. And I love that it's building that muscle. So if there's a founder listening that says, maybe I should finally crack open the laptop and share something, it's you're at the end of the day, you're in the game of creating value. This is a awesome playground to go do that at a very micro scale, to then go figure out how to take the bigger swings and build the businesses, the venture studios. So Ben, this has been a super fun conversation. I feel like awesome. You told me 10 years ago that I'd be sitting down with the author of Lean Analytics and jamming for a little bit. I would have told you were crazy.
And still talking about Lean Analytics. By the way, as you were talking there, Johnny, I was like, but I'm no Dan Martell. Like that. Now that guy's a machine. Like there's machines, and then there's Dan, right? So like,
well, I think that I think, and Dan would say if he was on the podcast with us now, it's like, do the version that energizes you.
Yes.
Right. Don't go try to be Dan Martell. There's one of those. I'll tell you, that guy, it does not feel like work for him. I spent a lot of hours with Dan.
I could not do Instagram. I'll tell you, man, like the way, I mean, you got to look a certain way too. So like kudos to him and the genetics, but like, man, that guy's a content machine, and like, but he's, again, like, this is not a Dan Martell schmooze fest, but like that guy's created an insane amount of value for many, many people. Like put more value out than you get back, but it comes back. It really does. It sounds cheesy a bit, but it does. You asked me about founder recruiting. Well, guess what? Like writing Focus Chaos attracts founders to Highline Beta. It attracts talent. Like it attracts co-investors. So there's method to that madness, and that there's reward that comes out of that. So yeah, it's a lot of fun.
Yeah. Well, if you're listening to the episode, you made it this far, you've got to go check out Focus Chaos. It is a incredibly well done, well written. Ben, I'll be following along. I really enjoyed our conversation today, and appreciate you taking the time.
Yeah. Thank you guys. I really appreciate it. It was a lot of fun.
Yeah.